Cells Philly. I hope everyone is okay today. I just finished eating, so I hope I don't have any salad in my mouth. I hope everyone is doing well. No, I think I'll leave the glasses on. So I wanted to come on again with Julie Simmons from Brandywine Lending to talk a little bit about how do you qualify for a mortgage. I have been asked some very strange questions lately. A lot. But I want you guys to know the real deal. I want you guys to know what it is that you need to do in order to qualify for a loan. I think many of you know the basics. Decent credit score, you need a form of income, and you need some money in the bank. I say that in most of my videos, right? But I want you guys to hear a little bit more about those basics and a little bit more about the process of becoming approved for a loan. Because there's a little bit more to it than just those three things, or there's a little bit more to those three things that you guys need to know. All right, so you guys remember Julie Simmons. She was on before, and she helped us understand the new calculations for student loan debt in regards to mortgage lending. So let's bring Julie on. Let's get right to it. You know what to do. If you have a question, down below. I will find it whether you are on Facebook or YouTube. And of course, if you like this content, share it with your friends. Follow me on YouTube, and we will be doing many, many more of these. All right. Julie, here you are.
How are you?
I'm doing fabulous. How about you?
I am doing wonderfully on this. I think it's Thursday.
It is a Thursday.
It's been such a long week.
Well, you know what? It's just a small amount of time for you and I in this business, right? 1 week is nothing. We understand over time how things work, but there's some people who are very new to this business, very new to the idea of home ownership, and especially new to the idea of borrowing money. So let's take a few moments here. We have about a half an hour to field questions and talk to people and just give them a little bit of knowledge. So I wanted to just bring Julie on, guys, again, to just talk about the basics of becoming approved for a mortgage. And just, I want to hear it all. As much as you can jam into this session, Julie, let's put your name up. If you have any questions.
I love to talk, so I will jam so much into this session. Everyone's going to become an expert.
Okay.
So first step is the pre-approval process. And a lot of times people will say, well, I'll get pre-approved once I find the house that I want, because finding the house is more important. And it is not just because I work in this industry that I tell you that is absolutely incorrect. You spend so much time thinking about, I want to live in this house, in this neighborhood, in this town, in this school district. You need to care as much about the finances as you do about the house that you're going to live in, because you need to make sure that that payment's going to make sense for you every month. And you need to make sure that you have an understanding of what the closing costs and the down payment requirements are going to be, so that you don't find that perfect house and fall in love and then be totally blindsided by the fact that this payment is more than you expected it to be. So I'm going to take you through right now the pre-approval process and what it looks like and the things that I look for and the things that I have to look at. So the first thing that you do when you get pre-qualified, really basic, is complete the application. It's not very long. It's really basic stuff. Should take you about 10 minutes. It's not a big deal. Your name, your address, your phone number, birth date, social security number, information about your employment. That's kind of it. There's not really that much more. There's not anything you shouldn't know. The thing that takes the amount of time is you have to assemble documents to send in, because I have to validate everything that you say on your application in order to complete the pre-qualification process. So you're going to tell me that you make X amount of dollars per month, and maybe you didn't realize, based on how the application is worded, that I'm looking for your gross number, not your net number. I don't care what comes home in your checking account every month. I care about that pre-tax number. So you may actually qualify for more because I went in and validated that income, because you do have more money to play with, because you didn't understand that what I was looking for as far as income. So the documents that you're typically going to send me, assuming that you are a W-2 employee that you don't presently own a home, because then we start adding more and more documents. But the basic stuff that I need is going to be 30 days of your most recent pay stubs. I'm going to need 60 pages. I'm sorry, 6 pages, 60 days. So 2 months of your bank statements, all pages. So you can't just send me the first page with a summary or a screenshot with the balance. I need the actual whole statement. One of the things that the lender is very particular about, all lenders are very particular about, is deposits. And it's because it's a Patriot Act issue.
And what is that? What is that?
So the Patriot Act was established after 9/11. It's about money laundering and about terroristic acts. And so they need to, if you're putting money in an account, they want to know where that money came from. So they're going to see every month that your paycheck comes in, and they're going to see that it's a direct deposit, and they're not going to question that. But then there's those people who have $2,000 here and $4,000 there. They want to know where that money's coming from. They want to make sure that you can source that money. Otherwise, they will not allow you to use that money.
Oh,
so
okay.
Cash is a very big no-no when it comes to mortgages. You cannot use cash. It is not an option to use cash. You must have the money in your account, and you must be able to show where those funds came from.
Okay, so no money under your mattress.
No money under the mattress.
No money.
Put it in your account now if you're preparing to buy a house, so that it can sit there so it shows as a previous balance. It's called seasoning the money. Season your money like you would season something that you're cooking. Let it sit, let it percolate, let it taste good, and then you're good. But you cannot use cash or funds that you cannot source. And that goes into gift funds and things like that. They want to know where every penny's coming from. And that's just, banking regulations. It's just kind of what it is. So bank statements. A lot of times people want to show me every account that they have, their retirement account, their checking account. Sometimes they have an account that has $20 in it. I don't need to see that. I literally only need to see whatever accounts you are going to use for closing costs.
All right.
So you don't need to send me every statement for every, single account that you have, just the ones that you plan to use. If you plan to use them all, then absolutely send me everything. No big deal. I'm happy to take it all. I'd rather have too much than too little. So next thing that I need is 2 years of W-2. So right now we're in 2019, 2020. You'll send me your W-2s and a copy of your driver's license. And that's it. That's all I need to get the ball rolling. From the time that you complete your application and submit to me your supporting documents, it takes me about a half an hour to complete the pre-approval process. It doesn't take that long. And then you're done, and then you can go shopping. So things I'm looking for when I go through and validate all of your income and all the things, I am looking to see that you have enough money to close. Like I mentioned, each program has a different required down payment, and then there's closing costs in addition to the down payment. So I need to make sure that you have enough assets to close. Now, if you don't have enough assets to close, what's going to happen is I still may be able to pre-approve you for a certain amount, but I'm going to say to Stacy, I can approve them for this X amount of dollars. However, they're going to need what's called a seller's assist, where it's a much longer conversation, but there's ways that you can have the seller help offset your closing costs.
Mm-hmm.
And so, we can save that question for another time and kind of circle back to it if there's an interest in this call. So I'm just validating that income and that money to close. The reason that they're looking for your W-2s is, especially if you're an hourly employee as opposed to a salaried employee. When you are an hourly employee, they're going to take a 2-year average of the money that you made, which has been really challenging for a lot of people because 2020 with COVID, some people that were hourly, depending on what industry you work in, a lot of people that worked in the service industry were impacted and were home and were furloughed. And but that it will roll off eventually. But for right now, we still have 2020 that we're dealing with for everyone. So we would take a 2-year average on your income for that. And so I would be looking at that. The lender really doesn't care if you're buying $1 million house or if you're buying $100,000 house.
Mhm.
What they care about is how that payment, coupled with all the other money that you spend on a monthly basis of things that would be on your credit card. So they're not going to be looking at like, oh, I went to Wawa and I bought a cup of coffee, or I bought a hoagie, or I went out to dinner. The only thing they care about is things that are on your credit report. So credit card bills, car payments, student loans if you have them, if you have an existing mortgage, if you have whatever's going to be on your credit report, plus this new house divided by your income that comes in gives you a ratio called your debt to income ratio. And one of the only things the lender cares about is your debt to income ratio. So they don't care if you buy $1 million house, as long as that payment works with your specific debt to income ratio, then that's kind of the biggest thing that I'm looking for. And the debt to income ratio is not a hard and fast number. It's kind of a moving target a little bit. So if your credit is higher, you have a little bit more wiggle room as far as how high you can go on your debt to income ratio. If your credit's lower, then you have less wiggle room. They want to see your debt to income ratio lower because you're a higher risk, because your credit's lower. If you have debt, I can't think of the word. My brain just went. But if you have things that are on your credit report that are in collections and things like that, that will also cause you to have a lower debt to income ratio. The two different programs that most people work with are either conventional or FHA. FHA tends to have a lot more wiggle room as far as your debt to income ratio and the numbers that they allow. So with good
So let
credit,
me ask you a question, Julie.
yeah, absolutely.
And then let's see if we have any questions on the internet here. So debt to income ratio, you
Yeah.
said varies by individual. So it's
Everyone
not,
has their own debt to income ratio. So they take everything on your, what the lender's going to look at is what's called your back end debt to income ratio. There's two different, there's a front end and the back end. And this is probably more information than you'll ever need, but the front end is just how that housing payment impacts your income, like how it compares to your income. And then your back end is all of your debts plus this new payment. So they're looking at all of the debts that you carry. So you have a car payment, a credit card payment, and a student loan. And each of those is $100 each. So now you have the $300, and then your new housing payment is going to be $700. So you have $1,000 of debt, and then you divide that by your income, and say your income is $2,000. So 1,000 divided by 2,000 is going to give you a debt to income ratio of 0.5, so 50%. Mm-hmm. And I made those numbers so easy because they're never that
right. We love the easy math. And this is on a monthly basis.
This is on a monthly basis. So your debt to income ratio right now is a 50. That's what it would look like for me. So, okay, so at a 50, you can probably, most likely, depending on your credit, go FHA. As long as you're above 620, you can go FHA. If you want to go conventional, depends on your credit score. So 50 is too high. 49.99 is okay, could be okay, but 50 is too high for conventional. So that's how I start to determine what program is most appropriate for you.
Okay.
Is that that debt to income ratio.
All right, let's answer a question here. Asha Downing asks, what if you don't have any credit?
So you have to have credit in order to get a mortgage. I worked with this lovely, lovely couple, and they had a car payment back in like 2016 and never since then. And they're like, yeah, we just pay our bills every month. We don't have any credit. We don't have credit cards. We don't have anything. We don't have any car payments. The lender needs a way to standardize what they do. And so that's why they look at your credit score and your debt to income ratio, because they need something that they can measure. They can't spend the time to manually look at every single person. So they have to have a base level of criteria in place so they have something to look at. And so that's why they look at the credit score. That's why they look at your debt to income ratio. So if you don't have a credit score, the thing that you should do to develop one very quickly is to get a secured credit card. You can just Google secured credit card and get one. And then just put your gas on it every month. You don't have to, run up a big bill, just gas, coffee, groceries, something simple, and make sure that you're paying it off every month. And you'll pretty within 6 months, you should be able to establish credit pretty quickly, and your credit score will be good.
Okay. So I usually tell clients, if they tell me I have this issue, that issue with my credit, I tell them that they're approximately 18 months away from qualifying for a loan, because
It
I
just
also,
depends on what the problem is, because it could be something easy to fix, or it could be something that's going to take some time. You just
well,
never
and sometimes that's coupled with, I need to save a little bit more money.
know.
I need to organize myself. I need to really get my budget together. And I really want people to do that prior to buying a house.
And that's why I think that pre-approval process is really important, because part of what you just said is saving up to make sure that you have enough for the down payment and closing costs, and making sure the last thing that you want to do is get into this new house and be so excited to be a homeowner and then have something go wrong. There's no landlord to call anymore. There's no one to fix your leaky roof or your, messed up heater but you. And so you don't want to deplete all of your savings for the down payment and closing costs and have nothing, and then be, cold or wet or whatever issue that you have. So it's really important to, make sure that you are in a financially comfortable position before you take on home ownership, because it's not
Right.
just, the cost of my mortgage is less than what I'm paying in rent. There's, other costs of home ownership. You have to do
They're
maintenance on it.
absolutely.
And
And
they always
so,
come at the worst time.
exactly. Now there are programs that provide home ownership with down payment assistance. But I would suggest, even if you get one of those programs, I have sellers agents who still will say no and take another offer because that offer has more money down. So my suggestion to all of you is to just get into a habit of saving money. If I can just say this, just save as much money as you can. Use those programs to help you, but have as much money as you can possibly saved. All right. So money. So we talked about money.
So we talked about getting pre-approved.
Mm-hmm.
So next step is you're going to go find a house. But the thing that I think is really important to note is that every house, even if it's the same purchase price, is going to cost you a different amount every month. So it's not like I'm shopping for a $200,000 house and I know that my $200,000 house is going to cost me, and I'm making up numbers in my head, $1,100 a month. It's not that way. It's not that simple. What makes it not that simple is every house has a different tax bill. And
Mm-hmm.
so 9 out of 10 houses at $200,000 are going to come in somewhere between, and again, with my made up $1,100 a month payment, $1,050 to $1,200. But the house that you ultimately end up falling in love with for whatever reason and get emotionally attached to is going to inadvertently be the one that has taxes that are like $4,000 higher than everything else that you looked at. And all of a sudden, it costs more than you expected it to. So it's really important to work with the lender that you're working with to make sure that they run you the numbers before Stacy takes you out to see the house, because you want to make sure that that monthly payment works for your budget and works for, makes you comfortable. And maybe, that house is a little bit more, and you see it online and you really like it and you say, okay, you know what? I know this house is going to cost me, maybe $100 extra a month than I wanted to pay, but I think I'm going to really like it and I'm okay to splurge. And you know what? I was being conservative because I didn't want to, spend too much, but I think this house meets all of my needs. I'm going to be here for a long time. I'm really comfortable with this. Or you're going to say, thank God I found out that this house is $100 more a month and I didn't go see it, because I don't want to spend that much money and I'm not comfortable spending that much money. And so this isn't a good house for me.
So what I suggest is, when we go to look at houses, that if you really think this is a house you like, and I really like to only go out, Julie, to look at houses that a client really, really likes.
Mm-hmm.
So give me your top 5 out of the 20 that you saw online. We'll go look at those 5. And then, if it's possible, let's get that same day, for the best one, let's get a new pre-approval with that house price and that house's taxes, so that we can see exactly what that is, so the buyer can make a very informed choice.
And I like to encourage people to send me those houses before they go see them.
Okay.
So before you go, shoot me a text. Send me, I'm going to see 123 Main Street. I'm going to see, 456 Elm Street, and whatever it is you're going to see. Send me those addresses of the ones that you think that you're really going to like. And I will say, okay, 123 Main Street, it's going to cost you X amount a month, and it's going to cost you whatever in closing costs. And then
Yeah,
And
because the worst thing is to find a house that you like and you really can't afford it.
exactly. So
You don't want that.
I encourage you to run those numbers before you go see the house and make sure that it works for you. And each house is different. And when I do the original pre-qualification, usually I'll say to you, okay, you're pre-qualified, say to $200,000 based on $4,000 in taxes. So if you see something with at 200,000 with around 4,000 in taxes, you know that your monthly payment is going to be in line with what we talked about. If you see a house that has a $200,000 purchase price that now has $6,500 in taxes, well, that's not what we talked about. So maybe you want to have me run those numbers just to confirm that you're happy with this payment, because 4,000 to 6,500 is a very different number and will affect your monthly payment in a very different way. And if your ratios are tight, you may not qualify for that $200,000 house. It doesn't I never write pre-qualification letters unless I'm specifically asked to, because I like to write them for the house that you're going under contract for or going to try and go under contract for at the purchase price that you're going to offer, because I think it's really important to look at those numbers and make sure that they make sense for you. And then let's say, I had pre-qualified you up to 200 and you found a house that needed some work and it's only 150. Well, the seller doesn't need to see that you can go to 200,000, because then
Exactly.
they'll bid you up and say, well, we want to come up a little bit. No, I'm going to write that pre-qualification letter for you at 150. And let's say they come back and say 160 and you say, well, 155. I will write you another letter at 150. I will write you that letter as many times as I need to until you are under contract, so that you have so that you present your offer in the best possible light.
Right.
So do you guys seller too much?
Right. So do you guys hear this? So Julie is saying that she is a part of your support team, just like your real estate agent. We are not working against you. We are working for you and with you, and we are hoping to have a successful outcome for you as the buyer. So use Julie as a resource when you are ready to buy a home, and she will help you as best as possible be successful. And the number one way to do that is to know what you can afford realistically. There is no pie in the sky. There's no guessing. I like to be as realistic as possible. This way, you'll understand that as well, and you'll have a lender who can support you in that, because that's all we want. We want people to own their own home, and we want them to do it in a way that makes them and their family comfortable.
It should be a fun time buying your house. And when you're stressing about what you don't know of the process and being afraid of the finances and being scared, it sucks all of the fun out of it. And so Stacy's job and my job is to walk you through this to make it fun and make it stress-free, and spend as much time as you need to explaining to you the things that you don't understand, and making sure that you understand, okay, so we are going to have closing costs, and here's what makes up the closing costs, and here's why they do these certain things for closing costs. The way that my process works is I have a preliminary conversation with all new borrowers, and I get to know them, and I hear about the house that they want to buy and how much they want to spend per month and how much they've saved up and where they think their credit is and things like that. Then they do the application. Then we do another call. And what we do on that next call is I send them a worksheet that breaks out all of the closing costs. And a lot of times I ask them, is there a house that you saw out there that is maybe a little bit more than you think you can afford? Let's run the numbers on that. Let's see if you're right. And so one of two things happens at the end of that when we do that call. Either they're right and the house is more than they can afford, and then they know they can't shop that high, or they are pleasantly surprised, like, oh, I had no idea it would be that inexpensive, because rates are really low right now. And so maybe they have, discovered that they can actually afford something a little more than what they thought. And then they know where they should be shopping, and they know what price point to be at. And that's a really important first step, is to be shopping in the right place, because
Mm-hmm.
If you are comfortable with the payment a little bit higher, maybe you get a little bit more of the house that you want. I mean,
Mm-hmm.
every house is always, unless you're building it from scratch and have an unlimited budget, every house is going to be a compromise. It's unavoidable. And that's just kind of how it works. So maybe you'll just have to compromise a little bit less if you know exactly what you can afford.
Okay, I love it. So let's just talk quickly here about some of the things that clients ask me.
Yeah,
So I
absolutely.
had a client today ask me if they take out a mortgage loan and they buy a house for much less, can they use the balance to fix up the house? Almost like change from a dollar bill. And what's the answer to that?
So the answer to that is no. The way that the pre-qualification works is you could purchase a house up to a certain amount given a certain down payment. And so nothing can be put into the mortgage except for the mortgage. So when you do a refinance, you can roll some of your costs into the home. When you initially purchase a house, the only thing that can be put into the mortgage is the actual mortgage. So if the house costs 200,000 and you have a I have to do math again. I have to go back to 100,000. If you're going to buy a house for 100,000 and you have, actually, I can do 200,000. I can do this math. $200,000 house, 5% down payment is $10,000. Did I do that math right?
Yeah. 200,000 is 5% is 10,000. Yeah.
Yeah, I did it. All right. I'm impressed with myself. I don't do math well. You think as a finance person, I would do math in all my head, but I do not. So anyway, $10,000. So you have a $190,000 loan. Well, you were pre-qualified for 225, but that doesn't mean anything because that has no bearing on that particular home.
Okay.
There are loans that are available. I'm doing one right now, actually, that are renovation loans. So what happens with that loan is you're buying your $200,000 house and you want to do $50,000 worth of repairs
Right.
to the home. So
Mm-hmm.
what would happen is the appraiser would go out and they would appraise the house, not with how the house looks today, but how the house is going to look
Right.
after you've spent that 50,000. And as long as the house appraises for the purchase price plus the renovations, then you can get a loan for that amount. But you don't get to make change.
Right. Okay. That's good. Now let's just talk about, I say, the different parts of a mortgage. So when someone finally gets a mortgage and they get their mortgage statement in the mail, what does that mortgage dollar amount comprise of? What are the different pieces in a mortgage?
So there's the principal amount that's owed. So if again, we'll go back to that $200,000 purchase with the 10,000. So the principal amount that's owed is that $190,000 that you borrowed.
Mm-hmm.
And then you have your monthly payment. Your monthly payment is going to be made up of 4, possibly 5 things. So you have your principal, which is the money that you borrowed, that 190,000 that you have to pay
Mm-hmm.
back. So
Mm-hmm.
part of that payment is going to go to principal. Then there's the interest on the loan. So you're going to pay
Mm-hmm.
back interest. Next is when you do escrows, you're going to escrow money each month so that when your taxes come due, that they'll pay your taxes. So part of that is your tax escrow. Same
Mm-hmm.
thing with homeowners insurance. Every month you're going to put a little bit of money aside so that when your homeowner's insurance bill comes due, the lender will pay it for you. So that's number
Mm-hmm.
4. And then if you do not have 20% down in your home on a conventional loan, or if you have an FHA loan, that this is forever, you will have mortgage insurance. And so
Okay.
those are the 5 components of
Mm-hmm.
what makes up your total monthly payment.
Okay. All right, guys. We don't have any more questions here, Julie. Is there anything else you want to say about the basics and of the process of getting a mortgage for a
I
home?
would say just remember to educate yourself and spend some time getting to understand the numbers, where they come from, spend some time with your lender, making sure that that monthly payment works for you,
Right.
what the closing costs are. Have you saved up enough? Do you feel comfortable, with how much is going to be required of you at settlement and that you have enough to live on after, and that, sometimes when it rains, it pours, and that you have a little reserves.
All right. Well, I appreciate your time, Julie, as always. Thank you so much for coming on. Thank you, thank you, thank you so much. Here's Julie's information down at the bottom. If you have any more questions after we're off live, just make sure you leave a comment and I will make sure Julie gets that. All right, Julie, you have a great night.
Thank you so much, Stacey. Thanks, everyone.
Bye-bye. So that was Julie, guys. Julie Simmons from Brandywine Lending. Here's our information. And you guys know who I am. I am Stacey from Stacey Sells Philly. Follow me on Facebook, YouTube, Instagram. If you have any questions, please let me know. If you want to see some special content here, I can name a dozen right now, but let's think about it. House hacking, Airbnb. Are you interested in becoming an investor of a different sort? Are you looking for multifamily? Are you looking to bring your family together? You need a large home. What about ground up construction? We want to talk about that. How about you want to buy from a contractor already, like Toll Brothers or something like that? Lots of them going around here. So if you have any questions or any topics that you'd like to talk about and see answered here at Stacey Sells Philly, just let me know. All right, guys, have a great one. How do I end this thing?